Welcome to Market Monday from the investment team in the trust department at the First National Bank. While there are not a lot of information points or economic data points coming out over the next couple of weeks, what we are going to see are a few really consequential ones. So we're paying attention, especially in light of the recent weakening in some of the economic reports. We're not saying that the economic reports are suggesting a weakening economy, but they do appear mixed at this point, whereas before they were almost uniformly strong or stronger than expected. So this week we get consumer confidence, and that's important because consumer spending represents about 2/3 of GDP growth. So if the consumer is confident, they're more likely to keep spending and so on. We're watching that number pretty carefully. Analysts seem to expect that it's going to come in weaker than it did on the last reading. We're not so sure. We're not seeing signs of that. So what happens in the event that this comes in a little bit stronger? Well, it's going to play into this tug of war that's going on between investors who are hoping for a rate cut and those who are looking closer at the reality of things and realize probably a rate cut is not in the cards in the very near future. Going into later in the week, we get some information on the labor market. We'll get information on outlooks and the vaunted Federal Open Market Committee rate decision. And this decision is expected to come in flat. In other words, they're not going to do anything. And there's not a big chance of anything happening in this movement, even in the interest rate futures markets. They're not giving much chance to that at all, if any. So looking at the Fed decision, what's important here? It's going to be the commentary that comes out with it. So they will issue a press release, and in that press release, they're going to give some detailed information as to where they see things playing out over the next few months. And, it really remains to be seen. Are they going to remain somewhat hawkish and resistant to the idea of a near-term rate cut, or are they going to become more dovish and openly start embracing this idea more closely in light of the recent PCE number that came out? And we're going to talk about that because the media harped on it as a sure sign that the market, is ready and that the Fed is going to be ready to cut rates as soon as September, which we think is wildly premature to make that call. But in any case, moving forward, we'll get information on, again, sentiment and labor market. Non-farm Friday coming out on the 2nd. That's a big deal. That number has consistently come in much stronger than expected. And when I say they, analyst community is only expecting about 175,000 jobs created. They're expecting a decline from the last period. We're not so sure we're going to see that. If recent history is any kind of guide, that number might be under what actually happens. So we'll have to see. In any case, more information rounding out about the labor market and outlooks. We'll get information on wholesale inventories and trade. That's important because that gives us an idea. Are inventories building? Are firms, ordering less for sale to the consumer, or are consumers continuing to buy aggressively and inventories are dwindling down and wholesalers just can't keep up? So this is important information, and it's taken in the context of everything else that's going on in the economy for us to come to some sort of a conclusion. But our idea is that we've not seen any kind of weakening based on inventories and sales numbers, and those are important when you're coming to your conclusion as to what's the near-term outlook. Let's talk about this. So consumer confidence, which is coming out tomorrow, we've overlaid here basically decades of consumer confidence information and, laid that out with U.S. recessions in red. And you can see here that, a decline in consumer confidence has preceded every single recession during this period. More significantly, though, it's a substantial decline in consumer confidence that has caused the problem. Not this choppy sideways action that we see at various points on the curve here, and like we've been seeing recently. So a lot of attention was given to a lower than expected consumer confidence number that came out recently saying, this opens the floodgates for the Fed to start easing rates. And, does it really? This pattern doesn't suggest that at all. And it's not even in the zone of, what looks like it's preceded all of the prior recessions in this period that we're looking at. So we're not going to go ahead and say, the Fed's clear here. It's still muddy water. Here's the unemployment rate. This line represents the natural long-term unemployment rate that you got in economics class, and here's where we're at. The economy is still hot. Now, the labor market is apparently, in terms of unemployment, starting to show signs that it might be weakening, might be being the main word here. So, again, we have to take a wait-and-see approach. This is still well below the average level of unemployment that's sustainable. In other words, the economy is still running too hot by this metric. When we talk about the PCE indicator, which came out last time and actually came in a good way, where it looked like, okay, inflation, according to the Fed's view, because they use this indicator, might be weakening to a point where we can actually, see them cutting in the future. And let's really examine this. So the 0.2% that it grew, if I run this calculation, that annualizes to 2.4%. 2.43% to be precise when you use the right math. So when you're looking at this indicator, that's still above 2% that the Fed has as its long-term historical target. So is this telling us that the Fed's ready to cut? Not really. The Taylor rule, which is an econometric model, we've talked about this rule before, basically tells us what is the policy rate for the Fed if they're targeting a certain rate of inflation. And in fact, if the Fed at 5.5% for this rate is correct, they are actually targeting 2.69% inflation, not 2% inflation. And that leaves no room for a cut either for targeting this level of inflation, which is higher than the one we just talked about here at, that mathematically is the same equivalent as about 2.4%. So, this suggests that they need to actually hike rates. Rates are not high enough, not low enough. So we're kind of thinking, there is some uncertainty about this, even though bond market participants in the media are harping on the fact that we're going to see rate cuts this year and maybe even a few of them now. And then we'll stop here with the dot plot, which shows what's happened, over to expectations over the past, meeting from the prior meeting, where Fed officials see rates at different points in the future. And it's important to note that these numbers have all shifted up. The weighted average of expectations has shifted higher, not lower, since the last meeting. So, or between the past two meetings, I should say. We're going to find out again later in the year, when the Fed comes out with its next dot plot, that, what's happening? Are these expectations starting to come down again, or are they remaining elevated? So the Fed is not as open of a book as the media seems to be making it. Let's move on to the S&P 500, which has had a modest pullback from its all-time highs. And, there's some interesting market action that's started to occur that we'd really want to take note of in light of the fact that it tends to precede bigger bouts of volatility in the market, and specifically corrections and other market downdrafts. So what we've been seeing, if you look throughout basically ever since October of last year, the ranges on the days were very small during the uptrends, and then the ranges on the day between the high and the low got bigger during the drawdown periods and preceding the drawdown periods. And what we're seeing now here, if you look at the bottom of this is called the average true range of the index, and that is climbing to very elevated levels. In fact, as far back as we're looking in through a year, it hasn't been this high. So we're seeing bigger moves on a day-to-day basis, a lot of risk-on, risk-off type behavior in the market, and that's not exactly indicative of a stability being in the market. So we're watching for potential volatility as we come into the fall. The market seems to be behaving in a manner that suggests volatility is going to increase, and so does the options market, where we look at the VIX volatility index that also shows, the elevated volatility expectations as this is coming up. So we're going to keep watching that. In terms of rates have shifted down on the Treasury curve, meaning that the bond investors community tends to agree to some degree with Wall Street analysts' expectations that there's going to be lower rates on the horizon and lower levels of inflation that come under control. But it's not a big move, and it's not necessarily definitive here in any sense of the word. These rates are still great. You can get well above 5% all the way out to 6 months, and then you're still in the 4% and up range across the entire curve. So for Treasury, the risk-free asset, that's great. Otherwise, fixed income investors that are in corporate bonds, the rates have come down again a little bit modestly, but you're getting great rates, above 5% out to a year, and then pretty close between 4.5-5% out the rest of the curve. So, income investors are getting paid. Investors that are looking to hedge volatility in their portfolios with bonds are getting paid, and this is good all around for everybody. And let's talk about this, because we brought up the idea that, hey, this might be the start of something bigger in terms of a volatile market and potentially pullbacks that continue. Let's not get scared about that. We need to zoom out and look at the bigger picture and see what happens over longer periods of time. We're not as concerned what's about to happen over the next couple of months. We're concerned over what's going to happen over periods of years. And, we're going to stick to a disciplined investment plan, which is what we advise clients to do. So if you found this video useful, great. We're glad to hear that. And if you ever have questions and want to talk to us, we're happy to talk. Thanks. Have a great day.